So the earnings story is clear. Okay, so let's go through some numbers there first, which is S&P 500 earnings will be probably down 4 or 5% third quarter, maybe a little better, down 3. But really,
they're down a little less than 3 right now.
Yeah, right. Well, they're tracking.
Let's say 3.
Whatever, 3. Fine. But the bigger story is in the S&P 1000, right? So mid-small caps are down almost double digits, 3 quarters in a row. And then we can agree that the engine of jobs growth in this country is small and medium businesses. Okay, is that fair? Can we agree on that?
Sure.
Right. So our call has been all along that the risk of a recession is predicated on a labor cycle. And my concern continues to be if this doesn't improve for small mid-cap companies, then they are going to have to start laying people off. So we don't know the answer to that yet. But I think to say that that risk is behind us is premature. So first of all, the market has rallied a lot in the last couple of months on a lot of good news. We've had, Fed cutting rates. We've had a lot of monetary stimulus, which is good. We've had a Brexit progress. We've had a trade deal progress. And we're back at the top end of the range. So I don't see any reason why we're going to break out here. It's the same setup we had this summer. Earnings season is going to be mixed. You guys were just talking about there's definitely mixed earnings out there. And until that mid-small cap area in particular starts to show some improvement, I think the risk of a employment cycle is elevated.
So I want you to listen to what Josh Brown said the other day about the market as a whole. And I want to react to it on the other side. I think it's relevant to this conversation. Here's Josh Brown.
Small cap stocks, they were the fly in the ointment just a month ago, up 4.5% in 7 trading sessions. Transports on a massive tear since the lower end of the range. And now the banks, Joe is right, I'm long JP Morgan, absolute wildebeest. Take a look at Bank of America at the upper end of its range. When you have banks working, more new highs for the ITB, by the way, home builders. You've got all of these things happening. I know the rhetoric is negative, but price is not paying attention to those things. Price wants higher, small caps working, transports working, banks working. These were the things that we said we needed. Now you have them. What are you going to tell me now, tough guy? What's wrong now?
Now, he's not speaking to you directly as tough guy, but he's speaking to people like you who are throwing shade on this market.
Well, what we're saying is that the risk reward is still not great, right? So I would put it back to Josh. Hey, Josh, I've owned 20-year Treasury bonds and destroyed stocks over the last year and a half. Small caps have underperformed large caps significantly. We're long utilities, we're long staples, and we're long financials because we think that's an early cycle group that could start to work. And our equity portfolio has outperformed the S&P 500 by 1,300 basis points in the last year. So don't tell me that being set up that way has been the wrong way. And until I see evidence, beyond just a few weeks of relative performance, I think it's premature. I think it's premature.
You've largely been right. I mean, we've given you props on the calls that you've made and how they've come to fruition. But I'm going to borrow a line from you and say, maybe the time to still be negative, this is not the time to be negative. That was many months ago. That was the time. Now's the time to say, okay, maybe this is evidence that things have troughed and that we are back working our way back up. You mentioned we've got maybe a Brexit resolution, more optimism on China trade. We know about all the negatives that are out there. Maybe now's the time to get a little more bullish.
Well, I think the time to get bullish was in August, right, because you were at the low end of the range. So once again, we're not that bearish. It's not like last year where the Fed was tightening rates and we thought we were going to 2,400. We've been saying 2,700. That's the low end of the range now. So we are incrementally more constructive on a potential recovery next year. Once again, I still think it's premature to think that we can break out of this range in a meaningful way and it's going to be led by cyclical stocks in a sustainable fashion. So I respect the market more than anybody. I agree with Josh in many senses that you have to listen to the market. And we look at a lot of different things. He picked on 3 or 4 things that are positive. I could tell you
there's a lot of things.
Well, I could pick on 3 or 4 things that are still telling somewhat negative, right? If things were really about to cyclically gear up, you would see rates actually accelerating a lot more than they already have. We're still at 170, 175. That's not a great outlook for growth.
No, but relative to where they were not that long ago?
Of course,
I mean, come on.
Of course. But it's starting. And so that's why we're at 3,000, Scott. That's why we have traded to the top end of the range. So I don't want to get boxed into a corner saying we're always negative. That's not true. We've been positive on many things within the equity market.
I didn't say you were always negative.
But that's the genre here of that we have to break out now. And I think the reality is we have to digest these gains we've just had. Let's see the evidence come in through the earnings season. Let's see if there actually is a deal, not just a phase 1 agreement, but there's a deal. Let's see if we get some of that stuff. Let's see if we have some more evidence that we have enough to punch through into 2020.
That's fair. I mean, with good reason to be skeptical, no?
No.
I mean, the market has been in this range. We've asked the question week after week after week after week, what's going to get stocks to break out of their range? There's been no ability to do that. So what changes it? to get somebody like Mike Wilson to change maybe his overall view?
Well, I would focus on profit margins, and I guess the question would be that they've been incredibly resilient. What would be your outlook there, and do you think that continued resilience and even an acceleration, which would be surprising, I think, to all of us, maybe takes your bull case scenario a little bit higher?
Yeah, I think that's exactly what we're looking for. So on the earnings side, the reason why earnings have been disappointing is because we have negative operating leverage.
Right.
So we have actually positive sales growth still in the economy. We have small mid-cap companies delivering 3, 4, 5% top line, but actually seeing 10% negative earnings growth. So until we start to see companies get ahead of the cost issue, right? And to be honest, what's going to sound ironic, if I saw companies start firing people, I would get more positive.
Right.
Because that is what's going to protect profit margins into next year. So that's exactly when, that's the thing I'm looking for, right? In other words, I'm rooting for a recession in some ways because that's what will get the flush in terms of expectations that still has to happen, and then we can have a cyclical recovery.
What about the ISMs? Do you think we're close to the bottom there?
Of course we're closer, obviously, because we've had such a decline. All of our leading indicators on the ISM suggest that we could still go lower, okay? And until, once again, I'm still very focused on the labor market. That's the only thing that's separating us from the ISMs going lower or not going lower. And I don't have enough evidence yet, Stephanie, to say that I know that things are going to trough here and start to reaccelerate. If we were trading,
you don't have as much evidence. You don't have the
well,
evidence either to suggest that things are going to get as bad as you say they might.
Well, I'm not saying they're going to get that much worse. I'm saying what's priced is that's not what's priced anymore. Okay, at 2,700, when cyclicals were really falling out of bed, and we had that conversation back in August, that was some of the stuff that I was looking to buy. We said actually we should be selling software in the high growth stocks then. That's happened now. That's good. The market is taking out some of the high flyers, but I think the cyclical stocks now are starting to price in a better recovery. I do think at 3,000 in the S&P where we are today is no longer pricing in a continued deceleration of the PMIs. It's actually anticipating some recovery. And that's all I'm saying. It's just, you got to look at price and the fundamentals.
So I got you. But if they're looking for a recovery, rates are moving up, why stay with the staples trade and utilities and these bond proxies, which have been so in favor that would likely fall out under that scenario?
But that's why we have financials on the other side, right? So we do have a barbell of some kind where we are putting a leg into one group of the cyclicals, which is financials. Because I think the earnings situation is actually better there, and in other cases they do have a handle on costs. And then the second thing is that I do think rates ultimately will make a move higher. So I think it's premature for things like materials and energy and some of the industrial areas, just from what we heard from some of the companies overnight, particularly TI, which is a very broad view on that. So. And by the way, I'm still not sold on the whole trade deal argument. As a firm, we're still not sold that there's meaningful progress having been made here as a truce. But I want to see more progress that we're actually going to roll back.
Nobody's going to fault you for having that view based
I agree.
on
I think people most agree with
where we've been over the last year at least. Pete, you got something?
Yeah, it's about the time frame, right? I mean, when you're talking about the trade war, so that was something I brought up earlier was I don't expect it to happen anytime really soon. I think this is something that eventually, and probably for political reasons as well, probably gets pushed off and pushed off and pushed off. How do we navigate through that time frame? That's the difficult part. If, let's say it's 6 months out, is navigating. You brought up the three categories where you're looking. Is that where you'd stay, or is there anything out there that you'd say, you know what, we're pretty daggone close on this particular world, whether it's tech or semis or whatever it might be?
Well, what we've been doing is we've been buying Japan and Europe. So we allocate globally, and actually Japan and Europe have begun to really outperform the U.S. Because we do think, and this is, people have been making the call growth to value. Well, we made that call a year ago, but with a little twist. Our call was that it was not going to be the cyclical parts of value that would work, but the defensive cohorts. And that now what we're getting is growth actually is underperforming value. It's not that value is outperforming growth. It's that the growth stocks are finally getting clipped. And that's why value is starting to outperform on a relative basis. I think this is really important. We are secular bulls, to be clear. We think global reflation is going to make a return next year once we do have a further slowdown. There's fiscal stimulus. We get past the election. Rates do finally recover because the Fed cuts a few more times. Okay, we get things going. We think the leverage, the real value opportunity in the world is in Japan, it's in Europe, and parts of emerging markets. That's the stuff that's really been thrown away. And that would include the cyclical parts of the United States equity market, not the darlings that have kind of led. So the thing we really got to be careful about getting too bearish is not so much that we're underweight growth, it's that we're underweight, that we're underweight cyclicals, and we have too much exposure in defenses because rates will eventually make a move higher. So we're aware of this.
That's what I mean.
That's why we're barbell, Scott. That's why we own
too
financials
much exposure
and
to the defensives.
Well, we have both. And it's not like we don't own any growth stocks, right? We're fully invested across the equity market. We have to skew in certain areas.
I'm not saying you shouldn't. I'm saying what you just said, that the risk is you got to be careful.
Agreed.
Playing that trade the way that it's going to continue to work the way it has.
Agreed.
Last question to you, the Fed. What if the Fed does this pause? What if they pause? They don't cut rates.
Well, I think if they pause, that means something's changed. That means that there's
for the better, right?
Exactly. So I think if they pause, that means they probably got better data on the ISMs in early November, or they have evidence that there's going to be better data there. There's going to be better employment data of some kind. I think their meetings before those come out, but something would have had to have changed that would make them feel better about the economic outlook. And by the way, will change at that point. We haven't seen it yet.